Okay, folks, we're still back on 2040 target date for State Street Global Advisors. Today, we're going to go over the fee structure. So you want to pay attention to your fees. That's how much they charge you to be part of their fund. So let's get started. The total expense ratio is 0.10. So that's your fee. So let's see, it looks like you pay $1 worth of expenses for every $1,000 that you have invested. So please take your time to read over all these different explanations. Okay, next up, we have the portfolio. The portfolio is very important. The portfolio is how the fund is structured. As you see, look at the red line in the graph. Your current allocation, it has 82% in stock. It has 18% in cash and bonds. So as time progresses, it'll taper down to about 35% equity, 65% stocks and bonds. And then while in retirement, it will assume that it will stay 35% stocks, 65% cash and bonds. Allocation of the fund. You can see the allocation of the fund right here. Another thing that's really important are the top holdings in the fund. So you see the top holdings: Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway, Johnson & Johnson, Google, ExxonMobil, JP Morgan Chase. So what they did is they diversified it over a few different industries. That way, if one industry is doing bad, you're not taking a hit in your whole fund. It's going to be very rare, unless the market is falling like crazy, that every industry is going to be hit at the same time. So they diversified it a lot. So in the long term, it does grow. It has about 20,000 holdings in it. You can see the net asset. Let's see here. The types of industries it has: financials, information technology, healthcare, industrials, consumer discretionary, communication services, consumer staples, energy, materials, real estate, and utilities. And you can see what percentage of the fund are allocated to each of those industries. When it comes to the bonds, you can see the different types of bonds it has: government bonds, corporate bonds, mortgage-backed securities, municipal bonds, fixed income, and asset-backed securities. Something else to pay attention to: the credit rating of the funds. AAA bonds are the most secure, but they offer the least return on your money. BBB, they're not as creditworthy. They normally offer a little bit more return because you have to take a lot more risk on those. You look at the maturity breakdown, it tells you when the maturities are normally going to expire. It also gives you a geographic breakdown on where the stocks are located at in your fund. So you see 65% are United States, about 12% from Europe, some emerging market, Japan, UK, Asian Pacific, North America, like Canada, Latin America, and some parts of Africa, and emerging markets in Europe. So that's it for part 2. Make sure you spend some time, look over all of these, get very familiar with them. All of your target dates are different. So stay tuned for part 3.